I'm very happy and delighted to welcome, Dr. Amelia Santos Polino. She is Chief of Investment Research in the Division of uh, Investment and Enterprise in UNCTAD, United Nations Conference on Trade and Development, which has been a major sort of provider of information, data, and analysis on world global flows of FDI and trade and other things. But on FDI, actually, they are the probably the only players. I mean, IMF has some balance of payment statistics, but if you talk of FDI proper, UNCTAD is the single kind of stop shop, and I have been in touch with the UNCTAD's division on this investment and enterprise. It has changed so many forms, and so it's hard to keep track of. But from the way back in 1990s, when I was in UNU, I used to be a regular visitor to this division, and World Investment Reports were started, and had an opportunity to contribute to them, and then used to launch them in Delhi for many years. So so I'm very happy that Amelia is here with us to share some insights from their recent work and world investment reports of last year and what is coming in this year's world investment report. So we will hear all that from Amelia, because she is very deeply involved in. You can come. Maybe pull a chair, Satiki. Yeah, there's. So, and FDI, I hardly need to emphasize, is a very integral part of the global economic integration or globalization. And between, the early part of this century and from 1990s actually, the annual average growth rate of FDI flows used to be of the growth of FDI flows used to be of the order of 15 to 20% per year. However, after global financial crisis, both FDI flows and trade flows have come down. The growth rate of these two forces of globalization has come down dramatically, and now in many years they are actually shrinking. So it's very important to hear from her what is happening in the area of FDI flows, and especially in this challenging environment around us, so many wars and other, fractured trading system kind of context. What do we expect, and what are the implications for us in India? Because after all, FDI is an important source of investable resources for the country. So that is the context. Amelia is here for this wider ISRD conference, which begins tomorrow. And I thought it was very important to have her speak to us on FDI flows and the analysis from the division in UNCTAD. If she's coming, it cannot only be for just one presentation at the conference. So she very graciously agreed. So you have the floor, Amelia.
Hi.
And then we have a panel of very senior experts to comment upon and add their insights after you have spoken. So I'll introduce them after you have spoken.
Thank you so much, Nagesh. Before I move up to the podium, I am extremely grateful for the invitation. I think we know each other for over
Long time.
I will not count because then I will disclose my age, but I'm very grateful for the invitation, especially because the distinguished panel that you have put together, also to see so many PhD students, to see a former intern of UNUY there who was there during my last year, now a full professor. So I am deeply, deeply touched, and thank you so much for the invitation. I think this is a good time to discuss foreign investment. The global geopolitical context tends to focus mostly on the trade war, but let's remember that investment is the other side of the coin, and who trades, who exports is the multinational enterprises. In some cases, state-owned enterprises, and you see a high concentration of these SOEs, especially in minerals and so on. But I think India drives the momentum in Asia. India drives the momentum in developing countries, but there are asymmetries. There is concentration that we worried about. I cannot present the full World Investment Report 2026 because we are still producing, but I am presenting the updated data that we launched this year in the occasion of Davos, and we keep on updating. One of the figures you will see was even quoted by Emmanuel Macron after Davos on the digital economy. So I want to do a sort of tour de force of the major trends, but also the issue of geopolitical tensions and how they affect investment. This is an ongoing research project that I have with Professor Emily Blanchard from Dartmouth University. And we started the first paper during the first Trump administration, just a sort of how the bilateral tensions between India and China were affecting investment. Now we are going broader, looking at the whole, because now it's not bilateral, it's the whole world. But I'll move on to the podium. So basically, my main entry point here, with respect to all the trends, is that not all investment respond equally to geopolitical tensions, to macroeconomic conditions, and so on. So there are two types of investment, as we know it. There is the efficiency-seeking investment, which is aimed at maximizing returns, but also minimizing production costs. This investment is very sticky because you cannot change the patterns of GDP-oriented investment as easily, and especially because this is the investment that is mostly exposed to trade tensions. Then there is the market-seeking investment, which is less likely to respond to geopolitical tension. This is mostly in the services sectors like retail, shopping, and so on. So this is my entry point in this discussion. Later, I will go to more specifics. So this is the structure of my presentation today. I'm going to discuss the landscape and where India sits in this landscape. Then a brief discussion on geopolitical tensions, because this is an ongoing work. And the World Investment Report this year is going to discuss important policy trends, not only investment policies, but also industrial policy trends, and how to protect investment, so to say, in this global environment. So let me start. Nagesh mentioned the role of UNCTAD in discussing and measuring foreign direct investment. As we know, we collect data and balance of payments from central banks from all countries. The IMF does that. But there is an area where we have a particular interest and focus is international project finance, because this is the vehicle through which most of the investment for sustainable infrastructure is mobilized through. And in fact, my paper on Thursday at the wider conference is about the cost of capital, because at the end of the day, not all investment is pure financial transaction, and it's not direct investment in a plan. Most of it comes in the form of loans or big PPP projects, corporate projects. So this is very concerning. I'm starting from the far right. There was a decrease of 16% in international project finance last year, and this mostly reflects the uncertainty in global financial markets. Investors are worried, and also interest rates, conditions, and so on and so forth. So when you see a decline in investment, it's because large infrastructure projects are put on hold. Then announced greenfield project, that is our metric of productive capacity investment, because then we can, as we know, we can see how much is going to be invested, how many employments are, the employment impact, how many employment positions is expected to be created, and so forth. So there has been an stagnation in this. Same with cross-border mergers and acquisition. Also, that reflects the global financial conditions. Unfortunately, also investors are cautious about the interest rates and the developments in advanced countries. Then global FDI. The headline is very positive. It's up by 14%, but we have a very important cautious note in the World Investment Report. This is mostly driven by investment in global financial centers. This is not productive investment. This is investment through what we call the conduit economies, the UK, Luxembourg, Cayman Islands. So this investment is speculative in nature, so it doesn't sit in it's not investment direct to the productive capacities of the economy. If we take that out, then the picture is not so positive. So these are the global developments, which I think it's important to focus. Take away, sustainable infrastructure is suffering because of the global financial markets. One point on cross-border and M&As, we know these are sophisticated financial transactions between multinational enterprises headquarters, more advanced countries. Countries like India do report activity in this sense, but low-income countries are not affected by this trend. So moving on, this is by region. Just looking at, this is balance of payment data again. And we saw here, I mean, this is more or less describing what I just explained. And the headline here is that the low-income countries are taking the hit of the global crisis. There was a decline of 5% in lower-income economies, and we are a few years to reach the Sustainable Development Goals, and yet we see that there is a big decline on investment. And basically, this reflects the structural vulnerabilities that low-income countries face, and the very restrained policy space that they face to attract investment. And again, this is one of the issues that we're going to look at the World Investment Report 2026. Then, again, this is not news, and if you read the different international organizations report, we voice the same issue, is that FDI remains a key source of external financing for developing economies. But for least developed countries, as you know, the UN category, remittances and official development assistance still count for more than 70% of all flows. So again, this reflects the structural constraints for low-income countries, least developed countries to attract private capital, which is a key issue that if you can do more PhD thesis on that, on how to improve the policy space and how to help countries to attract investment is still welcome. So let me zoom in a little bit to different countries and regions and try again to, as Nagesh asked me, to bring the discussion about India as the best as I can. We saw, again, inequalities between regions and important increase in Asia, especially because of the importance that countries like India have as a hub to attract investment in advanced manufacturing. This is mostly what has been driving investment. I try to compare here the BRICS with and without Russian Federation because of the South-South component. And again, there is a good momentum as a whole in the region, despite the recent decreases in China or recent slowdown in China. So developing countries as a whole declined, but most of the growth has been driven by South Asia and also by the South Asian Association for Regional Cooperation. But this is driven by a small number of large projects. It's not increased across the board in all countries. So here I'm just comparing the BRICS. I know this is an important year for India, and the Institute is a knowledge partner of the BRICS, and there are many areas. I have colleagues working on the GVC related impact, and I think there's going to be a presentation today. My team was working on that, so I don't want to preempt the discussion because it's mostly GVC oriented. And as you see, there is a lot of there is an importance role of investment, especially in investment in services, finance, IT, and research and development in India. This has what has been driving the momentum. In our research, we saw that, and perhaps later we can discuss that, the importance that investment-friendly policies like Make in India has made for this development. I know that I think that the policy is still being reviewed, but the role of this type of policies to ensure that the country remains competitive investment destination is important and is a learning experience for other developing countries. Also, the importance of improvements in the regulatory domain, and this also has been determinant to drive India's position as preferred investment hub in the region. Now, this is a sort of reproduction of the global picture that I showed before, but to India. Unfortunately, we see a decline in international project finance and greenfield projects, but this reflects a temporary momentum, temporary slowdown of the momentum, because we see not only in India, but across the board, a reduction of, we see weaker investment in large infrastructure and industrial projects. This is not particular of India, this is mirroring the global trend. However, in terms of overall investment balance of payment, we see an important increase of over 70% between 2024 and 2025. So this overall seems to suggest that while headline FDI inflows improve, underlying investment in new projects has slowed down and moderated in terms of long-term productive investment. But again, this is not unique to the country. This is reflecting the global trend. So if we see this picture, we see that India's position in the world in terms of the share of foreign direct investment in the world has been sort of flat during the years. There was a boom in 2020, then affected by the COVID pandemic. Sorry, I moved too fast. So basically, this trend suggests that India still, as I said before, remains an important destination for international investment, and the cycle seems to reflect or move with global investment cycle, as well as with domestic investment dynamics. Just to say that India's is around 3%. This reflects, I mean, the average of some developing countries. This is gross, yes. In terms of main sources of investment, United States remains there was an increase the last year, and the US remains a top investor in the region. When I saw Mauritius in the list, I was surprised. I would have predicted the other way around, but from Mauritius, we saw important investment in communications, IT, financial services, and this mostly comes after the India-Mauritius double taxation agreement. So this is perhaps the experts have another explanation. Basically, this is to encourage investment trade between the bilateral agreement. So we also look, I mean, as I said before, we will try to understand what is happening in terms of productive capacity and also in sustainable infrastructure. So greenfield investment in India, which is, as I said earlier, our measure of productive capacity, was concentrated mostly in services and manufacturing, which reflects the nature of India economy, and mostly driven by ICT, electronics, and electrical equipment, and so on, but also financial services. So this sectoral distribution highlights the continued interest of investors in digital and technology-related activities, alongside manufacturing and infrastructure-related industries. This is an issue that we studied in last year's report, and I think that report is still very prevalent, given that the digital economy is the fastest growing sector in the global economy and is driven by a handful of advanced countries and developing countries, including India. We'll show a couple of figures related to that. So last year, because we report investment not only in a sectoral productive sector, but also we look at investment in sustainable development related sectors. And we saw a decline in the momentum that we have observed in renewable energy after we saw the peak driven by the Paris Agreement. And then the digital economy has emerged as the driving force of international investment across developed and developing economies. So I thought it was interesting to bring back this discussion today. And so unfortunately, developed economies, especially the US, still drive greenfield investment in the digital economy. Of course, there are some emerging developing regions, and this basically reflects where the headquarters of foreign affiliates is located. It's mostly US, Europe, and then China and Singapore. And last year we did, if you are interested on that, a very detailed analysis on foreign affiliates and how light is this investment in terms of physical presence. This is mostly digital e-commerce type of investment, although we see that traditional e-commerce companies like Amazon and so on are starting to invest in physical infrastructure like data centers, cables, and basic ICT infrastructure. Even if there is this concentration in terms of high presence of developed countries, we saw an important key message was the increase in South-South investment. When we look at all of the investment in the digital economy, 40% is South-South, and it's mostly in Asia. So this is at least a good feature that we are starting to see a sort of deconcentration of the investment pattern. Then we look a little bit closer, trying to understand where do developing countries sit in this dynamic. And here we show an interesting picture. So basically 80% of greenfield investment in the digital economy is concentrated in 10 countries, 8 of which are in Asia. So you see here what I mentioned before, the difficulties that low-income economies have to grow in this space because of either the infrastructure base or the limited policy space. And of course, India here leads with 38% of total greenfield investment in the digital economy and 22% of investment in developing countries. They receive investment in developing countries. So again, this is driven by the specialization of the country in high and digital service. In terms of sectors, we saw an important increase over sixfold in digital services and solutions. And importantly, the rise of the data centers has been driving most of the investment in the digital economy. This figure is for developing countries. But on the right, we just wanted to compare, okay, how does this look vis-a-vis the investment in the basic infrastructure that country needs? Because investment will not come to data center into a country that doesn't have the physical infrastructure or the skill or the human capital. So according to the International Telecommunication Union, the annual need in basic ICT infrastructure is over 62 billion. This is the needs. The actual investment is 50 billion. So if you see the gap, and many countries will not make it, at least in the next decade, if this investment pace remain. Again, if you don't have the basic infrastructure, it's impossible to attract investment in segments like digital services and solutions and so on. So I'll move on because I don't know, Nagesh, how long do I have, but you flag me because I want to cover this part before moving to your political context. So as I mentioned earlier, developing Asia attracts most of the ICT investment in manufacturing. In fact, even though developed countries dominate, but half developing Asia attracts, in comparison to developing countries, half of the investment in the digital economy. And again, this is mostly on ICT manufacturing, and India again leads in comparison to other developing countries. And also, I mean, this demonstrate two issues that you know here in this room. One is the integration of the country in global supply chains, and also the robust manufacturing capabilities vis-a-vis of other lower income countries in the region and in other regions. Then this is a figure that will shows, okay, we know who are the main investors, we know there is a concentration, but putting together globally, who are the major recipients of data center investment? After the US, well, France number one, and India comes in the top 10 countries, the main recipients of data centers. So this corroborates the previous trends that we saw. And I mean, and basically, all this, what we call basic infrastructure, is key for given the competition that is in AI industry, in expanding the AI industry. So basically, the countries that are investing in the, as I said, in the basic infrastructure capacity are those who will have this have a foot in this competition for AI. Okay, so this is the global trend. So what happens to all these trends when you are in a context of tensions that affect the predictability of investment and affect the decisions of investors? So I will not bore you. I know this is a mixed audience with a lot of academics here in the room. I just wanted to show here some of the most important contributions since the trade tension 1.0 started. We did a very nice methodological paper with Emily Blanchard and other colleagues that was background for the World Investment Report, and that was published in the former Journal of Transnational Corporations. So what we try to do is to see how much investment projects are exposed to the trade shocks and what are the sectors that are exposed to the geopolitical tensions. So here we saw that most of the manufacturing, over 40% of manufacturing sectors were affected by the tariff war. So what we are trying to do now is to look beyond tariffs. What we're trying to do is to see what are other shocks and investment related policy issues that affect investment. And here I'm come back to this in a minute, because basically there are screenings, there is issues, bilateral investment tensions that are not picked up by media, because most of these indicators that are produced, that papers use, is either UN voting pattern, which has changed recently, or media announcement of tariffs, which are not necessarily enforced by Congress. So we're trying to see what else is there, like taking a CEO to prison, or a screening mechanism increase, and so on. So we saw that these trade tensions have been disproportionately affecting Southeast Asia. Some countries have benefited from what we call investment diversion, that is, investors moving to nearby location to avoid the trade tension. But what are the policy issues and the policy changes that have been driven this? One, and we know higher tariffs, we see business deregulation or increase in regulation, especially in some advanced countries. Lower support for green industries because of some of the announcements in advanced countries. Corporate taxes, reduced multilateral engagement, and FDI screening. These are issues that are not widely reported as tariffs. And if you look, for example, at some of the announcements recently, some of them have an investment requirement. So if you ask Malaysia that in addition to the increased tariff, they have to invest X amount in the US, when we look at the numbers, this is like over the percentage that this country receives as a total FDI. So the country doesn't have the capacity to realize an investment. So all these issues, we're trying to model them, is still a work in progress. So I will not bore you with a conceptual framework, but the question that we are trying to answer is that to what extent investors are changing where and how they invest in the world due to geopolitical tensions. So we try to isolate global geopolitical tensions from the push and pull factors driving investment. As we know, this have to do with comparative advantage, the business environment, and so on and so forth. So this is the methodology. Again, we try to identify inflection points that usually are not captured in the news. We deal with very sophisticated difference in difference approach. And again, we try to identify the difference between market seeking and efficiency seeking FDI. And for a country like India, the efficiency seeking FDI is very important due to the GVC integration. So again, some of we are focusing on three outcomes. One is investment diversion. That is investors moving from, let's say, China to Vietnam because they want to avoid, because basically the costs have become too high, or what we call tariff jumping, trying to avoid the conflict, and also try to benefit from that location to invest or export into a third market, and then neutral impact. There is no impact. So in that case, it's likely to investment to remain unchanged. So this is, in terms of bilateral and broader tensions, for example, we started looking at major economies that have had some sort of bilateral tensions in terms of foreign direct investment. For example, Japan in 2010, Korea 2016, Canada, Australia, European Union, these policy responses to the US policy responses. So trying to go beyond the bilateral part. So just quickly, some empirical findings. We see that first we look at total investment projects worldwide. We see the COVID impact, we see the recovery, we see the new geopolitical tensions post invasion in Ukraine and so on. That reflects the cycles. In the middle, we see a decrease on investment from high to low and low middle income economies, and this mostly is driven by the decline of the US in China. And I mean, this is reflected in the last trend line on the right. You see that the decline has been systematic. It's not only the last two, say, tariff war episodes. What we found interesting, and this is part of, I mean, this project started and some of this work was published in the Asian Integration Report of ADB last year. And basically we have seen a systematic shift from tertiary to efficiency seeking FDI, again, mostly driven by India. And again, this is very important to understand who is affected in this tariff war. So we see how efficiency seeking in the region move from mostly primary mining to tertiary, which is electronic equipment, manufacturing, and so on. So as I said, we model all this conceptual framework that I just described, and I will not bore you with the results. They are highlighted, those significance results are highlighted there. So basically what we can see is that there has been roughly a 50% decline in bilateral FDI between the US and China. This is the first column. And then we see also a decline in FDI projects from the US to China between 47-62% compared to pre-2016 level. And finally, we see the trade exposed, that indicator that we created in our first paper and that we improved now. We saw that trade exposed in efficiency seeking sectors had even sharper declines, and this is going forward. Especially, this reflects the vulnerability of global value chain related projects. And remember that you can protect at the top, but also, or you can deregulate at the top, but in GVC, down to the source, to the inputs, there are vulnerabilities, and this is something that we show that when you look at the whole value chain, there are different segments that are exposed differently. Moving quickly, we look the investment diversion to alternative markets, and the take-home message is that in terms of lower income countries, some have benefited because either their productive capacities or because the GBC relations. So we saw some important increases from Chinese FDI to both Latin America and ASEAN, especially countries like Vietnam. So there has been like the trade diversion that we all know, there has been also an investment diversion. And then when we move beyond the China-US conflict and look at broader geopolitical tensions, and again, this is something that we are trying to refine, we saw that increased tensions between other partners, not only China, the US, had a negative impact on investment. We saw a reduction of around 60%, 62% of investment. Again, when we look at this broader tension, there was also an investment diversion between from China to ASEAN and Central America. And again, trade-exposed projects seem to be affected. So this decline is not simply, I would not say simply a bilateral country pair phenomenon, but it shows a broader reaction when you have the EU reacting with another industrial policy response given an industrial policy decision or tariff decision of the US and so on. So it's very complex to capture in one indicator, but we are trying. Then this is the summary of the coefficients that I just presented. Very simple. Negative bar is a negative shock. So we see either a decrease on investment or deviation. And the positive bar is a positive increase. So we saw an increase, interesting, on investment from China to the US. So it's a way of circumventing the conflict, and a positive impact in the ASEAN economies in terms of attracting investment due to the three motives that I said, either tariff jumping or just circumventing the conflict. So what are the policy issues in all these complex features? I mean, regional integration still matters. And the fact that countries, despite all the geopolitical tensions, the issues that the WTO, and I'm happy that we have some WTO experts here and so on and so forth, countries continue engaging bilaterally, regionally, and this is important. But we show that the sectoral composition of investment is changing, and it's changing along geopolitical lines. So motivation for FDI relocation has intensified and is a reality and doesn't get as much attention as the trade attention. So we see that efficiency-seeking investment are more exposed to the negative impact of tariff change. We see that some economies could benefit from FDI relocation, especially as we saw in the case of ASEAN. And we need new policy approaches. And this is an important take home. We need regulatory stability, and we need, and we see that the export potential is more important than ever for attracting FDI. Our Secretary General said something very punchy for me the other day, saying that both the medium and long term start at the same time. And your industrial policy, although in the past you said we cannot pick winners, but you need to look at your export potential in order to attract FDI. Investment policy frameworks matters, and what India is doing in terms of the regulatory environment, in terms of new taxation, in terms of all these issues matters, because basically this will help to encourage resilience, diversification, and risk mitigation. And risk mitigation is one of the top indicators that investors look at. And for this, investment facilitation matters. Remember that investment promotion is the marketing tool, is totally different from investment facilitation. Investment facilitation is your package as a country that will bring together the trade and the industrial policy pack. Finally, just to kick off the discussion, we see that both reshoring and diversification of supply chains, we see that the countries and regions that are benefiting from diversification is driven by issues beyond market access. It has to do, it's rooted in solid economic fundamentals. And again, that's why policy matters. And finally, investing in the development of local suppliers, supporting industries is crucial. We need bottom-up approach. We need to include SMEs. We need to include all actors in this policy pack to improve the country's competitiveness. Thank you so much. Sorry if I took longer, but I look forward to the discussion.
Thank you very much, Amelia. This is a very well-rounded, very comprehensive presentation, giving to us fresh insights into how the trends and patterns of global FDI flows are shaping up, what are the key drivers, and the fact that geopolitics is emerging as the main driver. I mean, so we used to study the determinants of FDI, the market size, per capita income, infrastructure, labor, resources, etc. Now everything is pushed in the background. Geopolitics is the thing. Now, some of your results which you cited of the new empirical study relate to this rewiring before Trump disruptions, as I call it. So after Trump, perhaps another rewiring is shaping up. So anyhow, let me turn to our three very eminent, discussants, and maybe I begin from the right side and to this side. So Dr. Prabhakar Sahu, who is the program director at the Niti Aayog and a professor at Institute of Economic Growth, and himself a very important contributor to FDI literature. So over to you, Prabhakar.
Good afternoon. Thanks for how much ever you give, you are the chair. In India, it's always dil mange more. So no very quick response actually. I'll come back to questions if there are. Yeah, thanks for having. I think excellent presentations. There's just few things I marked. Let me clear that and then come to the points what we need to do. It's quite encouraging that 2025 that overall there is 14% increase in FDI flows. But what is disappointing is that FDI flows to the developing countries and least developed countries has gone down. It's not about the FDI as such. As a student of economics, we always think that trade is one of the major determinants for the convergence across the countries. And what you call the FDI works like an engine. It kind of links the countries with the global value chain, its technology, its branding, they have the financial muscle, all that we know. So FDI flows or the capital coming from outside with what you call very developed technology and the networking, it works connecting these countries and therefore actually the convergence takes place. So that is where when it shows that, okay, FDI flows to the LDCs and developing countries has slowed down, it's not a good thing. It's not only for the convergence, but it is also, close to 45% as I could make out, and then 33% from the remittances. It's close to 80% of your capital flows are, or what you call research flows are in these two items. And these two items get affected because of the heightened uncertainties and the kind of madness we see in last few years, particularly in last few months. So this is not something good for the, and when I look at what you call FDI flows, it is also not something very encouraging. Actually, I'm from the government, I should sound very positive, but I'm not sounding very positive because I'm talking from what you call my side as a student of economics. You see, when you look at the FDI flows to the sectors, it's not helping the global value chain. It's the data centers, it's the digital services, it's kind of, more financial investment going to the countries or what you call financial centers instead of real investment that is taking place, what is called greenfield investment. So that's not, again, good thing. And the same thing, what gets reflected for the whole world or for all the countries, so is for India. This lot of investment has come what you call for in digital services or Amazon and all that, they're investing to create warehouses, the data centers and all that, and also the data centers. It's again not coming to. Of course, we have received good amount of FDI in advanced manufacturing. It's automobile, it's electronics. We have done well in mobiles. There are some good stories to take away, but then we have not got FDI in the real sector, particularly the sector which we talk about. Dr. Nagesh Kumar and me, we always talk about the labor-intensive manufacturing because the power we have is the manpower, and we are not able to use this because we have not got what you call, we somehow we are not very successful to integrate it with to get integrated with the labor intensive manufacturing. Now, you see, it is not about last 5 years. I'm just speaking about the presentation made just now, that we got 41 billion on an average between 2022 2025 compared to 141. But that's just the minor thing. It's not that they have got close to 4 times more in last 5 years. If you look at last 25 years, you take per capita FDI inflows to China vis-a-vis India. It is almost close to 10 times. And today, if all these regression results, they're showing that, okay, it is the other way around that is happening. Like, FDI flows happening or outward FDI that is happening from China to US, I'm not surprised because they have got what they had to get. Now, in fact, they are going there to capture US companies. There is a paper by 2004 by one of the famous economists who told, you see, all this investment in Europe and US, there are indirect ways to get or control American technology. In fact, today, if the fight is going on for some time starting from 2016, it's not about trade imbalance only. It is about the supremacy over what you call defense, technology. It's all that. And China has done that. So I'm not surprised that it's not only, okay, maybe it has accelerated, these uncertainties have accelerated that led to 50% down that US investment to China. But over a period of time, China has been actually investing in all these developing countries. So overall, this not lot of good points to take. I think we can only tell that if you look at last 10 years, we have done much better when it comes to the FDI inflows to India. But I think we still have to do a lot more. Why I'm telling? It's not that, okay, it's a China plus one, things are moving away from China because of increase in cost of production, or people or countries or MNCs, they want to have the alternative supply chain, given the uncertainties they have come across with the China. Vietnam, all these small countries, they have got it, but they don't have the appetite or endowment to really capture more than that. So one country that comes to the forum, it is India. If you look at all the FDI determinants, the theoretical papers, starting from Dunning and all that, they will tell you it's the size of the market. We have size of the market, 4th largest, going to be the 5th largest. It's a growth prospect. It's the what you call the highest. It's having the highest growth rate among the top 10 economies. If you look at the stability, I think the most stable countries right now in the world is India. So, so everything. If we look at trade openness, we have been doing it. Maybe we need to do much more. And when you look at reforms, it is happening across the states. In fact, today the states are hungry to have investment. Every state has a investment conclave. Now the difference is this: you will come across in the paper that, okay, X state has signed 13 lakh crore investment in this investment conclave. But after 4 years, you realize that even 20% of that has not been realized. And when it comes to, see, at the central government level and being part of the 3 years, I can tell you, things are very progressive and very proactive. But it goes much faster than you can think of. It is about the states. Today, 5 states, they get more or less 75 to 85% of FDI flows. What is happening to others? We have 36, what do you call, states, union territories and all that. I think somewhere the states need to be very proactive in terms of reforms at the state, central government level, whether it is IVC, it's a Gati Shakti, everything I can name one by one. In fact, including the last one, the Press Note 3, which has kind of, diluted the rigid or punitive clauses, so that allows the investment from the Now it is mostly up to the states. I think we are doing things. Now, way forward, how do we go from here? The first thing is we need to really accelerate the ease of doing business. Now, ease of doing business, every time I think my friend, Dr. Danis is here, he would be talking much about it because he hates the ease of doing business. He's a man of ease of doing business. It's about the land and labor, the factor of productions. In a democratic country, it's not very easy. Whichever, whether it is state government or the central government, I have seen very closely the POSCO project which got abandoned in Odisha. It's less to do. It was less to do with the economics rationale. It's less to do with anything. It was about the politics. And in a democratic country, it's not very easy. When this government came in 2014, they had to get rid of, they tried 3 times through ordinance to get rid of the punitive clauses in the Land Acquisition Act of 2013. No, nobody wants to be seen as that anti-farmers, anti-landowners. Nobody wants to be seen as the labor. Okay, central government actually, they have consolidated 29 central laws into 4 industrial codes. It's said to be utilized. But then the state governments, they have more number of labor rules and regulations that matter. Rajasthan has done it. There are the early results showing that manufacturing is to be much, much better. And there are other states that are trying to follow it. So there is a bit of competition happening now because over a period of time, people also realize that, okay, this government or, that's kind of delivery system. Now, going forward, how do we really capitalize the potential we have? Because we have everything almost today. The manpower, the growth, the size. I don't think there is anything you can pinpoint. But when you look at the numbers, we have not really capitalized. I think the next 25 years, that is the time zone we have. This is the only chance you get for a big country like India. Once the working age population, which would start going down starting from 2040, it will never come back. It has never come back to any country. If China today, wherever it is today, it is basically that 35 years they made use it, like, early 80s to close to 2012, 2013. They lost the demographics. Now it is going to be reversed. The new normal would be like 4%, 3%, and maybe actually another 15 years, it's like 2%, close to that. So this next 25 years, if we want to really grow, or 22 years, at around 9%, the number of 30 trillion that comes from actually from Niti Aayog, and I was leading that. And it's very much feasible. It's not very aspirational like some economists made it like, 54 trillion and all that. With great difficulty, I came to a very feasible and realistic number that is like, you need to have 9% growth in US nominal terms, US dollar. If you take 1.5% or so, the US inflation rate, then you can grow something like 7 to 7.5%. Last 10 years, how much we have grown? We have grown by 6.4% in real US dollar. So what we need to do? We need to increase by 1%. But it's not 1% for 5 years or 10 years. It's for next 22 years. So when you become an elephant, you cannot really run faster. So that is where actually you need to maintain that kind of growth. What we need to do? We need to have this FDI, particularly in greenfield investment. Now, we have to push not only trade reforms. One of the points I actually made in the presentations, the export-oriented ecosystem that really helps. That is where there are structural reforms. High-level committees are working on it. In fact, I'm the convener of the trade working committee. So there are a lot of things happening now, and we have been kind of very active. I think Pritam that can tell me. I think we have signed 9 or 8 FTAs in the last 5 years. 8. So we are kind of very proactive. We are kind of not so active between 2011 to 2019, 18, 19, but we are part of that. But we need to think of bigger alliances. We need to be part of the bigger RTA blocks like RCEP and be part of the Asian global value chain. So that is something. Easier BITs, we have looked at the issues, but that is somewhere actually not giving a lot of confidence to foreign investors, whether it is legal security or the definition of capital host. I think it's time to really look at it. And of course, this is my personal views. And of course, I think we need to be again proactive, not at the central government level, state government level. It's not for the sector-wise policy. It's the component-wise policy. For example, this time the budget has announced that 40,000 crores for the electronics component ecosystem. That works, right? Like that, I think when it comes to the energy transition, energy equipments, or solar panel, like that, I think we need to go to the second layer while designing the policies, and that would attract what you call investment in the greenfield projects. Okay, I think we'll stop. I'm sorry if I've taken more time.
Very insightful points, Prabhakar. And so it brought for you, I think, the thinking from here and what we feel are our strengths, but still FDI somehow is not going to the areas we would benefit more from. Say, for instance, you mentioned about labor-intensive industries, where if we integrate ourselves with the global value chains in labor-intensive industries, the impact would be very high for job creation, and so these are some of the things which we need to be focusing on in the coming years. And he also mentioned there's not policies at the central level, but also the state governments, provincial governments play a very important role to appear to be more hospitable to FDI, and and some of the southern states are doing actually very well in India, Tamil Nadu or Maharashtra and Karnataka, Andhra Pradesh, Odisha. They are becoming very big magnets of FDI, where some of the northern and eastern states are lagging behind. So somehow we need to also push them into, becoming more proactive players for attracting FDI. So with that, let me turn to next speaker, Pritam Banerjee. And Pritam Banerjee, as I told you earlier, heads the Center for WTO Studies under Ministry of Commerce. And he's very deeply involved in supporting the Ministry of Commerce, thinking on various FTAs and responses to the agenda on the table of WTO ministerial. So over to you, Pritam.
I'll go to the question.
Sure.
Thank you and very good afternoon. Thanks to ISID for
Online
inviting me to join this very, very interesting conversation, this panel discussion, and my compliments to Dr. Amelia Santos for a fantastic presentation. I had the opportunity to go through it in detail. Really insightful, and my compliments to you. The challenge with following Dr. Prabhakar Sahu is that he has already spoken about 90% of the things anybody would have wanted to say, and I mean that in a complimentary way. So it makes my life much easier. So I'll limit my points to maybe three or four observations that I have. One, in terms of this whole debate between efficiency seeking and market seeking FDI, perhaps an interesting distinction, which actually follows from some of the points made in the presentation itself, is that we need to look at the G20 economies, or the economies which are large, maybe $300, $400 billion GDP size plus, in a different way in what drives investment into those countries, and the others in a different way, because typically these large economies will have a combination of both market seeking, because they have large markets, and efficiency seeking in particular sectors where they have that competitiveness. And in the other economies, the smaller economies, you would probably see two things. You would see efficiency seeking, but efficiency seeking will also depend on some of the trade issues that were discussed, both in terms of regional networks. So in the case of Southeast Asia, for example, you have a integral ASEAN region which has certain tariff advantages which allow regional value chains to be built. So particular economies might concentrate, so it operates as a more integrated economy with those kind of investment decisions being taken. So that's one, that's the first. And then if we come to the market seeking, and that's why I was saying the G20 economies probably need a separate more focused attention. And then these points have already been made. I'm just reiterating them. Is that there are a number of things which drive it. One is, of course, industrial policy. Even before you start seeing the trade outcomes, you will see industrial policy outcomes. And we have seen this definitely in the case of India, where our production linked in incentive schemes have led to significant FDI in specific sectors. In subsequent periods, they have led to export outcomes. In some cases, they have not. I mean, they are largely meant for a domestic market also in many cases. The other, of course, important factor to look in this whole discussion is the trade policy, which has also been brought up, and therefore the FTAs that you are signing. And there are two distinct things that are happening right now, despite all the turbulence. One is the tariff jumping that was mentioned. It is largely an outcome of the trade tension. So, for example, the data also confirmed this. We saw a huge amount of FDI moving out of China into Vietnam and Cambodia, precisely because, and this is prior to the current Trump administration, when the advantage still existed, when Vietnam and Cambodia still had market access to the US above and beyond the tariff obstruction that was being faced by Chinese exporters from the mainland. Some of that investment also moved to Latin America, countries like Mexico and Central America, and that comes up in the data that was shared in the presentation. But that's one. The one aspect is the tariff jumping. The other aspect is FTAs, because what FTAs do is that they bring binding tariff commitments in the bilateral trade, which especially in this time of geopolitical tension has become a very, very important aspect, because it allows businesses to plan out and make investments along the value chain, and pick the locations that they think are most efficient. And we have seen some of that as well. It comes up in the data in the presentation. A lot of the Japanese and Korean investment that flowed into India in the last decade and a half in specific sectors, and not just from Japan and Korea. Some of them originated in Singapore, because many of these companies, they operate their networks, manufacturing networks out of Southeast Asia, headquartered in Singapore. And in automobiles and electronics, you saw Korean and Japanese investment flow into India, precisely because we had investments with all the three regions. We had the Asia and India Trade in Goods Agreement. We had Japan, India, SEPA, and the Korean India SEPA. So these binding commitments led to the value chain related investments flowing into India subsequently. And we are seeing more of these FTAs come. We have recently signed, as was mentioned, a very large, often called the mother of all deals by some people, with the European Union. And a very interesting news article that I read just last evening was the German embassy here is actively seeking to hire more than 250 Indian students out of either engineering schools or even out of polytechnics, to take them as apprentices to Germany, because they are facing a massive shortage in skills given their demographics in specific parts of their manufacturing. So one is, of course, trying to this labor mobility concept that is happening, but not all of this will be addressable by moving workers. A lot of this activities, at least in the parts and components chain, will move to countries like India, where demographics support location of production, and the FTAs will therefore support that significantly. Now, the other aspect I think that we need to think about in terms of where the investment is moving is looking at not just the economies of scale of the economy, but the economies of scale of the specific production, sectoral production cluster. So, there have been enough literature talking about the hoteling aspects of investment as well. So, hoteling ideals are around, clustering of retail activities or even manufacturing, but this has the hoteling, the ideas of the hoteling theory can also be applied to FDI. And the reasons for that are simple. And, it is for those of us who follow, and, numbers are here for the digitally delivered services, ICT, etc., investment coming in. It typically tends to flow to no more than 4 or 5 locations, even in India. And the reason is these firms tend to cluster together because have access to skills, the economies of scale of the ecosystem, and increasingly in the parts and components network. So, factories will move where the entire ecosystem of manufacturing exists. whether they're serving the regional or the or the global markets. So you have these major clusters in India that Prabhakar was mentioning, and the in the case of a lot of these, as we move towards a situation where certification of manufacturing becomes important, where R&D, certification of manufacturing, and the entire ecosystem around that becomes important, we will see greater amounts of clustering taking place globally. So that's another factor that we need to look at, the economies of scale of the particular sectoral ecosystem and how that attracts investment, inward investment. And that brings me really to the last point, and this is from a more development aspect, and Prabhakar already has raised this issue in his comments, is that if you look at large economies, which are also large geographies, we have this tremendous amount of, and this is true for China, it's true for India, it's true for Brazil, that there are these few locations which attracts the majority, the lion's share of that investment. And that will obviously have a developmental impact, as Prabhakar was mentioning. In the case of India, there are about 5 states which account for most of our FDI, inward FDI. And that creates certain amount of developmental challenges in terms of movement of workers, remittances, and other kinds of issues that needs to be looked into. Lastly, I will end with the geopolitical tension, and one particular aspect is that Prabhakar was mentioning the Press Note 3, and as most of you are aware, I don't know if Dr. Santos Paulino is aware, this is the the regulation that applied to land border countries of India, targeting one particular country which will remain unnamed at this point in time. That has been somewhat diluted in the recent directive. The dilution comes in 2 ways. One, up to 10% investment has been made largely free of screening, because these are investments into Indian firms by Chinese investors. The other is that for the rest of the investment, which goes beyond this 10% cap, what has been thought about is a time-defined, more facilitated screening mechanism. But what India is doing in terms of policy is actually taking up from the playbook of the European Union and other countries that is rapidly emerging. So those of you who are aware of the so-called KUKA incident, I don't know how many of you are aware. KUKA was the world's leading robotics manufacturer, the high-tech, cutting-edge industrial robotics company. It was a German firm. And in those times, I'm talking about the 2015-16, around that time, there were hardly any significant screening rules for FDI in the European Union. They had it only for what they called critical infrastructure, which covered a few sectors, but for broad swaths of manufacturing, it was largely open in automatic route of investment. But a Chinese company took over KUKA. And there was a huge hue and cry in Germany, because it was seen that this was our closest competitor in industrial robotics. They have really taken over the jewel in the crown, and they will simply grab this technology and then just and this is exactly actually what happened. I mean, today China has leapfrogged way beyond Germany. Is the lowest cost, most economies of scale producer of industrial robotics. So post KUKA, the Germans started debating this, and they came up with a very strong screening mechanism, which is open-ended, covers all sectors, and the European Union followed. So what we will increasingly see in this geostrategic, so one is of course the broadly defined the whole Trumpian outcome of the world, but if we set that aside, you will see more of this happen. So our Press Note 3, for those of there's a tendency in the international press, I'll not name the list of usual suspects of economists and Wall Street journals of the world, who tend to castigate India for being obstructionist and hypersensitive to security issues. They tend to ignore that we are simply copying the playbook that was right there in front of them. So we are essentially reacting to the same geopolitical tensions. Our concerns are not very dissimilar from the concerns in those capitals. So I'll end that, and I think that will bring a lot of turbulence to the whole investment architecture. Thank you for giving me the time.
Thank you, Preetham. I think another very important intervention, and bringing more insights to the table, and including the strategic dimensions, like the ones you mentioned towards the end. of your remarks, and I'm sure they will be very important for our discussion following this. So let me turn to Danish. Danish Hashim is the head of the division in the Confederation of Indian Industries, which is the main industry body in the country. There are a few others, but CII is the sort of cutting edge of Indian industry, and there he directs the work of CII on the ease of doing business and value chains, global value chains, and all that. So he's very directly dealing with industry and leading industrial, companies, including the Apple, and all that. So very deeply involved and very familiar with what is going on. So over to you, Danish.
Good afternoon. And first of all, thank you so much for inviting me. It's always pleasure getting this kind of platform. And so it has also given me opportunity to get connected to two of my ex-colleagues, Dr. Prabhakar Sahu at IEG and then Dr. Pritam Banerjee at CII. And then, of course, what a wonderful presentation we had earlier today from ANTAD, and very insightful in a number of ways. Something that we have been thinking about for years, something at least I was aware that what is going on and where things are not actually matching up as per our expectations. But things have been very clearly revealed by this presentation today. So I have, in fact, as Pritam mentioned, that 90% of the things were covered by Prabhakar Sahu himself, and then there is hardly anything for me to do. So, so now whatever I do, it will be in negative territory. So, but I take the opportunity of being the last speaker. So two or three important points that came out from the presentation, and that first point was about growing FDI in developed economy and least developed economy and developing economy. They witnessed deterioration or say decline in FDI. That is certainly very, very worrying trend to me. Because that has a risk of, widening the gap between developed and developing economy. It has to be taken very seriously, and especially I'm more concerned about least developed economy. Economy like India and all that, we are not worried about. We can manage. But the thing is, what will happen to many of African economies? And there is a specific need for policy attention. In terms of their getting integrated, because ANTAD is working in that area in terms of ensuring that they are better integrated in global value chain. FDI is mostly going through aids over there. Why do we not actually use that kind of aid in improving the efficiency system of the country over there, so that there is the opportunity for greater, even assuming that initially it is a market-seeking investment, there's nothing wrong. Many economies, even from developing world, they will go and make investment in these least developing economies. So that is primarily a concern area for me. Another thing that emerged from this presentation is that developing economy are again witnessing negative growth. But good thing is that many of our ASEAN economies, including India and also India, they have witnessed a very good growth in FDI last year, going by project numbers. So that is again not surprising because much of the investment that is actually getting released from China, US, and all that, that is getting into ASEAN and fast-growing economy like India. But now the question and worry that comes is that, and that comes very clearly from the presentation, that how much of that is getting into greenfield investment. And that is something really very important. And that's something I have been always thinking about. Just a few days back or a couple of months back, I was, in fact, I'm a person on of productivity. So I was quite interested in seeing what has happened to productivity growth in factory sector, organized factory sector. And I actually took the pain of constructing the variables. In fact, claims also comes out with that. But that is for, not necessarily only for, say, factory sector. It is for other sectors also, including household and all that. But I was more interested in seeing the productivity growth in factory sector. And I was quite astonished to see that productivity growth since 2012 has witnessed a downward slope. I do not mean that it has been declining, but the growth has been declining, and that is a worrying sign. And so much so that contribution of productivity growth to output growth has come down to something like 2.5% from, say, 12.5% earlier. So this is the worrying sign. And so how will FDI come? And if you talk about manufacturing share in GDP, that has more or less stagnated at around 16%. Way back, we were talking about taking it to 25%, but now, in the new series, there is some improvement. But if you go by WDI indicators of the World Bank, you will see that manufacturing growth is declining. So these are good enough numbers to warn us that what needs to be done in India. And so here there are good number of things that we can do. And one of the things I believe that must be done at the earliest, and that is ensuring efficient delivery of public services to both citizens as well as businesses. So, like for example, Prime Minister of India keeps talking about improving ease of doing business as well as ease of living. There's absolutely no doubt about it that we have to improve the delivery of services. And how do you do it? Like, for example, in presentation, it was actually mentioned that we are having very good, FDI inflow in technology, ICT and data center and communication and digitization. So why don't we actually channelize this into, making delivery system more robust? And it is not so difficult. Like, for example, you have API-based system, AI-enabled services and all that. First of all, and the first thing that must be done at the on urgent basis, and it doesn't require even time and money. All you have to do is that, for example, suppose I need to actually apply for a license. All I need to do is that I just, I just tell the API-based or an AI-enabled portal that I want to apply for this form, and all the data is available in DigiLocker. All it has to do is that it'll make the consolidated applications. For example, other day I was there in a meeting of corporate affairs. They said that there are 42 forms, and tell me how it needs to be integrated. So I told them it's a very simple system. All you have to do is that you just integrate and avoid the common features. I don't have to actually fill out my name time and again. And then what happens is that it is circulated to all the departments concerned, and and there is a timeline, and within that we actually get the approval. It's as simple as that. So even at the state level, like Dr. Sahu mentioned about all the reforms being taken by state in improving ease of doing business, but how many states are there who are actually delivering the approvals on time? And there is again what you call as, and that's the, not many people actually talk about it. There is rent-seeking behavior. Why would I actually, why would I actually give you approval if I can meet you in person and then you know what happens? So this is point number one. So point number two, I would think about, regulatory and policy reforms. So going beyond this thing, like for example, suppose judicial reforms. That is one area where we have not done good enough. If you get into court system, like for example, other day I was reading somewhere that 10 lakh crores of rupees is locked up only in tax disputes. Can you believe it? So much of wastage of resources locked up in disputes. How do we clear it? So there has been Commercial Courts Act 2016, Arbitration Act, Mediation Act, but nothing appears to have taken off. And not many people are even talking about it. We have got used to living in that kind of situation. Similarly, IBC, we had such a wonderful reforms in 2016, but again, if you get into insolvency related issues, it takes a lot of time to get out of it. Similarly, single window system I spoke about, labor reforms. Much awaited reforms. Now we have come out with 4 labor codes. I hopefully that will be implemented. But that was a reform which should have been implemented decades back. Then other factor market reforms. Panelists mentioned about, say, land reforms or say taxation reforms, because if you go to a country like Vietnam or say China, there's a policy certainty, especially for MNCs. If you talk about transfer pricing, safe harbor rules and all that, they are much user-friendly, MNC-friendly. So how we actually attract them, that is something which is going to be utterly important. That's what I feel. And then when we are talking about getting FDI, we should not lose sight of our own sustainable growth and development. Like, for example, there may be certain sectors like data centers or say XYZ, but at the same time, we also have to be aware about our own necessity for creating employment, mass employment, not just, because data center investment in data and all that, that is only going to, take away some jobs. But at the same time, we have to be thinking of alternative policy, how we actually, continue to remain focused on textiles, and how we continue to remain focused on certain GVC related sectors. I'm talking about automobiles. It's not well connected with the global value chain. Then you talk about electronics. It has started getting connected thanks to PLI scheme. And then pharmaceuticals, and then chemicals. All these sectors are utterly important, and we have to actually remain mindful of promoting, them, and at the same time keeping an eye on employment. That is something which is very, very essential for us. And then promoting R&D and manufacturing. This is again very important. That our other day I was just seeing the R&D figure for us from 1980 down to 2023. Our our expenses, or rather our expenditure or R&D, has remained stagnant at 0.4% since 1980s. Till 2023, and China has moved from 0.6% between this time to 2.1%. South Korea has moved to 4% and all that. So unless we think about promoting R&D, why I'm saying this? Because FDI doesn't come in isolation, because most of the FDI, in fact, you may be aware, according to India data sources, our FDI went up to $81 billion last year. According to UNCTAD data, which was just presented, FDI went up to $43 billion. That was a rise of 73% from last year. But then much of the FDI is getting into portfolio investment, not into real sector. And that is something we have to think about, how we translate that coming into real sector. That is the important, and enhancing the share of manufacturing. A big economy like India can never sustain on just 15% of manufacturing share in GDP. Just not sustainable, according to me. We have to think about it, and we have to take it very seriously. And then another important point, I think I already mentioned, aids going to developing economies should be converted in developing a healthier ecosystem over there, and also building efficiency. And then the last point I would like to cover is, in fact, there are a number of others, but in interest of time, I'll not talk about them. But trade and investment reforms. Yeah, that is another important area. Like, for example, I was just thinking, if you not permit, say, investment from China, which is the second largest source of investment, and then US, is always volatile in today's time, where will FDI come from? I mean, we have to think about, like, for example, just 2-3 days back, there was some relaxation in PN3, Press Note 3. But is that good enough? Like, for example, we are celebrating that we are going to give approval in 60 days' time in certain strategic sectors. But is that a reform? That should be across the board. Why should we be celebrating that? 60 days or 90 days should be there for everyone. That is not a reform. Another point, whether 10% will make you attractive enough to have investment from China. I don't think so. Third point, I read in an article on Sunday, by making investment from China into India, you can have a larger stake of China, and China will remain more friendly. By not having China, we have adverse relations. So we have to think about how we actually attract investment, foreign direct investment, because investment is, to me, it is not just the bridging the gap between investment requirement. For me, it is technology transfer. And unless we have good technology transfer in the country, we will not be able to actually make progress on manufacturing, services, and other sectors. So with these few words, I'll take a leave. But once again, I would thank Dr. Kumar for giving me this opportunity, and it was wonderful listening to you. Thank you.
Thank you very much, Danish, for adding an industry perspective, in real sense of the term, very much an industry perspective on the kind of reforms that are needed, that are being done, and where the gaps are. And I'm sure my two colleagues, Prabhakar and Pritham, because they are very deeply involved in policy making processes have taken notes of what industry believes and thinks. So you will take the messages to the process of policy making. With that, we have, had presentations and remarks by all of our panelists. So I want to throw this, open to everyone who wants to participate. So I see one hand, and let's take. We are run past the time, but I think we can take 10 minutes to wrap it up with the comments. And so, Isha, okay, go ahead, Isha. Yeah. You can you speak in microphone? Yeah. Yeah, but there are online people, so who were making a lot of noise earlier.
The US-China trade conflict has reshaped global trade and FDI patterns.
Yes.
And there is large reallocation of FDI to third country economies. How far do you think the geopolitical alignment of these third countries would affect their exposure margins in terms of export competitiveness, import exposure, sourcing opportunities, and rerouting potential? Thank you.
First of all, thank you for this wonderful presentation. We get an idea what is happening. Now, two important things which come from this presentation, according to me, which is striking. One is there is a reverse movement of investment towards the developed countries. And I think Trump might have succeeded in the sense by imposing tariff. If you see that the investment is moving more towards US, then at least in his aim, he is successful. The other thing is that, which is a bad news, which Professor Shao and others have also mentioned, that the efficiency-seeking investment, which is supposed to come to countries like India, we are the worst hit in this whole process, in the sense developing countries. And the graph that you showed, that of course, the investment to China has declined, but that couldn't be offset by investment to other developing countries, because you see as a group, there is a decline. So even India, Vietnam couldn't offset that. Now, if that is the case, now the second, which is alarming to us. The other point which I want to mention, which is related to the kind of investment which is coming. So if the efficiency-seeking investment is not coming, is there a relocation of industry towards the developing north, to the developed north or not? So is it that they are once again moving towards the US and Western reshoring happening? So this is one. And the other question is that I don't think that even in the earlier period also, in case of India at least, FDI didn't come to labor-intensive industries. Basically, if you see that most of the industries that attracted FDI, automobile, electronics, engineering, chemicals, they're mid-level industries in terms of our intensity measurement, but they are labor-intensive industries according to the advanced north. So there, the substitution of labor was low, so they have actually shifted to developing countries. But we are talking about textiles, leather, and these industries have been relocated long back, in the sense that either they are mechanized or these kind of industries have been shifted from West to China and other countries long back. So we cannot expect that kind of investment again coming to India. But the other related point which need to be looked at is this, that is there any country where you see FDI coming to textiles, to leather, and to labor-intensive industries, where the domestic capital has no big investment in that sector? So is it possible that they would be coming and our industrialists, they would not be investing in these sectors? It is simply impossible. These are some.
Good points. Any other? Yes, Bina.
Thanks for the excellent presentations. This is only conceptual clarity, actually. How do you distinguish between market seeking and efficiency seeking FDI? Because I think it can overlap. That is.
Yes. Any other? If none, then I turn back to the panel. With Amelia and then the three, yeah. So very brief.
Very brief, excellent questions, excellent points. This is, I mean, what we did, we work with colleagues with the Asian Development Bank and we use input-output tables to try to see really the sectoral composition, because I agree with you, there is, you can have a GVC sector that is market seeking, but it's basically on the function of the investment. So we use both greenfield investment and look at the function of the business, not the merely description. So it's basically GVC oriented. It has a productive capacity and a spillover and productivity effect. And if you see the figure, I don't know if my presentation is up there, you can see clearly that market seeking is mostly lower services, low technology intensive services. But I mean, I can exchange with you the methodology, but it was using input-output table precisely because that overlap. Because at the aggregate, there might be overlap, but then when you look at the function of the investment, it's a clear distinction what is productive, what is has a spillover effects in terms of labor and local economy, and what is actually a service provision. So that was the distinction. The second point I think is very important, and first, on the issue, I mean, we have to remember that India is a mature economy. If we compare with the neighbors and with Latin America, of course, there might be some comparisons like with Costa Rica or Mexico, and then you can see the investment diversion effort. But India is a mature economy in comparison to the others. Economies sort of caught in the middle, as I would say. So the impact is not expected to be the same. In terms of geopolitical alignment, we have our own critique to that because we have seen that the world has changed in the last year. For example, I myself follow the investment resolution. I facilitate the investment resolution in the General Assembly. Before, it used to go, boom, no problem. Last year, it was put to the vote, and there were two votes against that resolution. One was the US, the other is Argentina. So, and there was one abstention. So you see that even the geopolitical alignment, which we use as a measure, is like what was the vote in the US, in the UN, that is not only longer a predictor of this tension. I would say more that GVC insertion or specialization is more of a predictor of how this will roll out if you have already a productive capacity in place. I think that's more of a predictor than, that's why it goes to Vietnam, to Cambodia, and not, for example, to other countries. And the same in Latin America. That's why it goes to Costa Rica instead of Honduras, because you have already domestic capacity in place. So that will say that. And I think also that is that respond the first question. And what we have seen is mostly flight to safety. Investors are jumping. There are two phenomena here: the flight to safety, jumping the conflict, and the other one is taking advantage. And I think it was Dr. Banerjee that mentioned the issue of market access. And that's why we see, and I disagree with the point that the US is winning in terms of the bilateral with China. For them, it's sort of defeat, because what we're seeing is that China is circumventing and is investing in the US, is circumventing the conflict, and is gaining access to some markets. So in this case, it's China, like technology, China has the upper hand in terms of these two conflict. And on the domestic capital, important one. But again, we have to remember that not every developing country has the capacity, has the strong domestic business sector to complement investment. And that's why the importance of FDI to crowd in more investment instead of crowding out and complementing. And that's why we emphasize, and we published a report in January this year on the role of partnerships. A PPP, like in the old times, doesn't work. It's like how the private sector can help to mobilize, to complement and mobilize the domestic sector. I just wanted to make a quick point before opening, and the issue that you mentioned about business facilitation and the importance of facilitating the services delivery. Last year, in 2024, our report was in the importance of digital investment facilitation tools to improve and the business climate to improve investment flows. We had a model, we used different surveys, we used the World Bank, we used the DESA, and to look at what is the political environment and the whole investment ecosystem. And on average, we saw that there was an increase in FDI of around 12% if you have the right investment facilitation tools and digital investment facilitation tools. And countries like India, overperform in comparison to others. But also, and responding to your point, there was a positive impact in terms of business creation locally and in terms of employment across the board. So that's an important point that we made it to, but I think it has to remain at the table. Thank you.
Very good. Thank you. And in the same order, 1 minute each to keep it in place.
Yeah. The first point about the US-China conflict, how it leads to diversification, what you call movement of FDI to other countries and all that, whether it would make a difference to their margins, of course it would. Because all this investment that is moving away, that is not on the basis of the economic rationale. But let me clarify, it's not because of the US-China conflict that started from 2016 onwards, the tariff war. If you look historically, if you look at 1929 onwards, you have 5 or 6 phases of tariff wars. And every time, both the parties, whether it is US, Europe, or US other countries, they lost out and they came back. So it is a phase which we are going through. But personally, what I feel, that US-China conflict is a very good thing for India.
Yeah.
And I wish it continues. But only problem is, see, here is a man takes it instead of fighting with the one, fighting with everybody. And we are suffering because of that. Like, you see, all this China plus concept, it's not only supply chain stability, it's also kind of, it gave options to all of us. Vietnam, Bangladesh, and all some Mexico, they capitalized. It's small countries, it's much easier to take policy decisions much quicker and all that. But I tell you, they have very limited capacity, small market, endowments are limited. So it is India's turn. And so rightly, it's only India's turn. But that is where actually the stupid war and everything is happening. That's making life difficult. So, of course, there are short-term reactions. It's only China-US conflict has accelerated this. But before this also, there are incentives, disincentives to attract investment. Now it's very aggressive reshoring that is happening because somebody is putting a gun on you or telling that 500 billion invest karo yahan pe. No, you invest 500 billion. Otherwise, I'll put 50%. It's like, but these are all short-term things which settle down in the medium term. Very quickly, just this one point, this labor-intensive sector, it's not exactly true that, okay, that Indian investors need to start and create an ecosystem where others. But there are countries, what's Vietnam, what's Bangladesh, they have done it. I think we need to figure it out. How do we get these MNCs into the labor-intensive sector? There are states that have done very well. When it comes to leather, when it comes to textiles, Tamil Nadu has done very well. 35% of India's total exports actually comes from Tamil Nadu. If they could do it, it's about not the wishful thinking. It's about the intention to make it happen. Do you have 50,000, hostel capacity for the women to work in a textile factory, like the way China has done it and Tamil Nadu, to some extent, they have started? Can we do that? Can make it happen? So it's all about.
But with Apple's example, it is now seemingly possible to do. Then large factories employing 100,000 workers in one plant and with the residences, dormitories for the workers and all that. So now it's seemingly.
Unfortunately, what is happening is, sorry to do just 10 seconds. Very recently, actually 4 or 5 days back, we brought out a fiscal health index report. That was focusing, and rightly so. It's about provision of effective public services. Okay, not only to businesses or the households, but 10 plus states, they are not in a position to manage their own finances. The committed expenditure is going so severe, and they're in a very troubled time. Actually, I'll tell you, how will they really think about doing or creating an ecosystem for
Infra.
labor intensive manufacturing when they cannot pay to their transport people, they cannot pay to their, that's a terrible situation.
There's a huge variation in the capacity of states, So over to you, Pritam.
Thank you. Specifically, perhaps just 2 points. One on the, the whole concept of labor intensive, and I think it goes back in the literature to what Jeremy talks about in value chains, as well as the old idea from cost on transaction cost. So what firms will choose to outsource and what they will keep in-house will depend on these factors. So even in, the labor intensive, we need to see what exact component of it. So, you take a firm like Zara, it will do a lot of the piecework will be completely outsourced. The more high-end fashion work will be, still remain, but it will not remain forever. If they develop a relationship which is, in by the course framework that they can trust, then that will also be outsourced. So we have seen that. So exactly to your point. So those relationships in many industries have played out, and the subcontractor who is working independently might be a local capitalist or not. In some cases, it might not be. For very small countries, you might have, for example, in the Apple example, a Taiwanese firm moved into China first. So these relationships are complex and depends a lot on sectors, and the point at which the outsourcing starts happening will depend on the specifics of the sector. Last one point on the value of the investment that we are seeing, and I don't know to what extent, Doctor, you have looked at this, is that just like we have intra-industry trade, we have intra-industry investments that complement this. So a lot of the movement that is happening, okay, part of it definitely might be due to turbulence, but we are also seeing this divergence in terms of the share of certain sectors and trade in terms of their value vis-a-vis others. So, just to take an illustrative example, chapters 84 and 85, which is electronics, engineering, goods, their relative value as a basket of total trade has really increased over time, while the relative value of other sectors, labor intensive, have declined. So maybe some of this is also at work. High tech investments flowing between developed countries is the noise that you are capturing, which have to be then separated out. So I'll stop there. Thank you.
Thank you. Danish.
Yeah, on the second part, FDI will come only when you yourself are investing enough. Like I mentioned, about that study which I undertook, and I found that next fixed capital formation at current prices, that has been declining continuously, and that is, very surprising and shocking. So how will you think that when your own capital investment is declining, how you think that there'll be enough interest on the part of say foreign investors? That is point number one. Point number two is about GVC integration. So GVC, we have to be conscious of the fact that GVC and trade investment policy work hand in hand. So in most of the cases, what has happened is that you are thinking about investment policy in a very restricted way. You are thinking about GVC policy in a very restricted way. Just to give you an example, we are thinking about, for example, it's an open fact. Any economist will tell you that countries in the initial stage, they actually remain more focused on backward linkages. So there is a great opportunity for us to connect it to backward linkages, and like, for example, what happened in case of Apple recently. So why we are not able to take that advantage? Thanks to Niti Aayog, now we have started relaxing QCOs and all that on a number of items. Many companies, they came to me and they were telling me that if I have to source actually raw materials, where do I go actually? Because those raw materials are not available in that quality and at that price. So that comes in the way of developing a sound value chain system. So we have to be, and then when I say investment, again, FDI will come. Only you have flexible, export facility, what we call as trade facilitation. Trade facilitation, again, on paper, it looks very strong. But when it comes to actual realization, there is still lots of reform that are yet to be actually effectively implemented on the ground. So trade facilitation definitely, needs to be given importance. And another point on labor-intensive sector, in fact, labor is one of another very important areas for me. So other day I was interested, and that's purely from academic point of view, that what happens to marginal productivity, what is the rate, relationship between marginal productivity and real wage rate in the Indian industry. Like, for example, Ministry of Finance, even in their latest economic survey, they have been arguing that, industry is paying less than what labor deserves. That is, marginal productivity is growing, marginal productivity of labor is growing at a faster rate than the real wages. Initially, I was not actually agreeing to this fact, but then I estimated marginal productivity of labor and I compared that with the real wage. But what turned out to be a fact is that marginal productivity of labor has indeed increased at much faster rate than the real wage. So where is the problem? Problem is not that you ask industry to pay higher, wages to labor. The problem is that you had a labor law. After 99 labor, if you are crossing the threshold under Industrial Disputes Act 1948, from 99 to 100, you actually come under lots of compliances. And as a result, instead of actually increasing the scale of operation, you actually set up another firm. So as a result, what has happened is that your marginal productivity of labor is still high, and then you are actually not building the scale, and therefore demand for labor is suppressed. There is the excess supply of labor. All you have to do is that you increase the threshold. Fortunately, in labor courts, now states are required to increase the threshold to 300 labor. But is that enough? The kind of scale that we are talking about at China level or any other country level, even 300 is not going to be enough. And that is actually the reason why we have, missing middle companies.
Yeah.
Unless you address also all these problems, if you see holistically, they are all interrelated.
Exactly.
And that is why labor-intensive manufacturing is not getting well integrated in global value chain. This is the answer I would think, could be given to your question.
Thank you, Danish. Preetham wants to take very
I'll
make
just
a
take
very
10
brief.
seconds because, Danish's point brings back some memories which is connected with you, Dr. Nagesh.
Oh, really?
So, this was, during my master's. This is not to, show how senior Dr. Nagesh is, but when I was doing my master's, my internship.
Directly, you are telling you are young.
So when I was doing
more.
So during my summer master internship during my time in JNU, I was with RIS and Dr. Nagesh Kumar was the DG at that time. And one of the projects we were doing, sir, is to look at the textile sector exporters, if you believe, And so, Danish, we had gone to Noida, which was at that time a major cluster for textiles. And we saw exactly that. So just to illustrate, we saw one firm under 6 different registrations. And they were all next to each other. They had some kind of a barrier to show that they were independent companies.
But they were
They were not. They were one single operation precisely to overcome this labor law challenge. So
This is that with the factory or the service. Most of the time it is because of the land cost, not because of the labor.
no, but they were in this that when we were doing the service.
It is rising like anything. So either you have to do it like this. You are not getting space elsewhere. So you have to find out.
No,
They were-
why
they were
make
next to each
another
other.
company?
They were
I
next
mean,
to each other, and they said this. This was the reason why there were 6 different firms.
Yeah.
Because every firm, below the threshold.
Yeah. Well, I think we have got more than what we had bargained for. A very rich discussion on FDI and all issues related with that. Every one of our speakers, right from Amelia's major presentation, very comprehensive presentation, and our 3 panelists and every one of you, I think it was very rich discussion. It's hard to summarize that, but I think I'll ask one of our colleagues to turn it into a good policy brief, summarizing some of the important messages that came out from this discussion. And I think it's really very late, and I'm sure everyone would be waiting for lunch. So let me not take any more of your time, and just invite you to join me in giving a very big round of applause. So thank you very much, Amelia. You should not take so long to come back to India. Next time.
Happy to come back.
Yes.
Yes.
So next year, or no, when this WIR is, prepared, come and launch it here.
I take home one very important message because we could, for example, let me give you one simple example. If you take a small island developing states, we have been following what is happening with large developing countries. There are many LDCs have not received more than 3 investment projects in the last 40 years. But you are sending me home with another reality. Big countries have other problem, and it's the regional inequalities. And I think in the investment policy debate, this is not very much taken into account. In the development debate, yes. In my work at Wider, yes. But in the investment policy debate, is very important, and the concentration of investment in certain regions. So this is. Thank you so much for that.
Thank you.
Thank you.